Hey guys, welcome again to Everything Business. If it's your first time, thanks for stopping by. Please remember to like, subscribe, and share, and hit that notification bell that you never miss a free tutorial. If you are one of my regular viewers, thank you for coming back, and I hope that this video will be informative. Today I'll be talking about control accounts. In my last episode, we were talking about the SBA, and I hope that was helpful for you. Right, some persons have reached out to me, and I've gotten additional help. Thank you for that. Right, today we're going to be talking about control accounts. All right, so let's get right into it. So then, what are control accounts? Right, so control accounts check the accuracy of the purchases and the sales ledgers. They are able to do this by combining similar items in the purchases and the sales ledger. For example, combining or adding all the opening balances in the sales ledger, or adding all the money paid to you by the debtors. Right? So control accounts, we don't want to make errors in accounting. Therefore, control accounts is that type of control system that we use to check the ledgers to see if any error was made. Now we have two types of control accounts. We have the sales ledger control, which is also called debtors control. We also have the purchases ledger control, which is also called the creditors control. Right? And it is important to note that if the control account balances at the end of the period, then it means that there was no error made in the ledgers. So essentially, you want to get your control accounts to balance when you do your control accounts, because that would mean that there is no error in the purchases or the sales ledger. All right, so let's get right into it. So how does control account work? How does it work? All right, let's take, for example, you have a sales ledger, right? So this is my simple sales ledger, and remember that the sales ledger has the debtors accounts, right? And if you don't remember, right, much about the sales ledger, you can just check in the description below, right? There is a video there that I did about the books of original entry. Now in my sales ledger here, right, you will see I have two debtors, Tom and Mark. Right, now at the beginning of the period, Tom owed $500 to me, and Mark owed $300. Right, during the year, during the month, January 4 to be exact, Tom paid $450 cash, and Mark paid on January 7 $100 using check. Right, so we have bank right there. At the end of the period, Tom owed me $50 and Mark owed me $200. Right, so let's look how the control account, how we would record it in the control account. So the control account basically, as I said before, adds up all the totals or all the balances or all the items that are in the ledgers. So if you look here, you will realize that this is my sales ledger control account. It has a debit side, it has a credit side, and we're going to talk about that in a little while. Right, now if you realize that $800 there on the debit side, right, it is a summation of the 500 and the 300, which are the opening balances for Tom and Mark respectively. Right, on the credit side, we add the $450 for Tom and the $100, right, we get $550. And we have cash or bank, or cash and bank, because Tom paid in cash and Mark uses a check. And then the closing balances, right, the closing balance, right, you would subtract 550, which is this 550, from the 800 to get 250. Right, and if you add the closing balances from the sales ledger, you would realize that it comes back to 250. So 50 plus 200, right, would give you the 250 here, just the same. Alright, so that is basically how the control account works. It's a totals account, right? It adds all the items that are in the sales ledger into one. They put everything into one, so it's like a summary. The control account is like a summary, right? So it sums up what happens in the ledger to see if there is any mistake made. Alright, so let's look at the sales ledger. The format for the sales ledger are the debtors control account. Alright, so this is the format, right? Two very important principles that you need to get right is that we have a debit side, we have a credit side, but then is to understand what each side is used for. And so the debit side is used to record items that increases your debtors, while the credit side is used to record items that decreases your debtors. So anything that increases your debtors, you put on the debit side. Anything that decreases your debtor, you put on the credit side. I could say it in another way. Anything that increases what people owe you, you put it on the debit side. And anything that decreases what people owe you, you put it on the credit side. Alright, now I know you may be wondering why it is that I have 2 opening balances and I also have 2 closing balances. Now this is a debtors account. And if you remember from my first video from Introduction to Accounting, we state that debtors account, right, to increase a debtors account, which is an asset account, then we would make a debit entry. To decrease an asset account, we make a credit entry. So this is an asset account, and therefore to increase it, we would make a debit entry. Now we have 2 opening balances, and the reason why we have 2 opening balances, right, especially the reason why we have this balance here on the credit side, is because we owe our debtors money. Yeah man, our debtors are normally people who owe we money, you know, right? But now we actually say, well, we owe our debtors money, and it happens in the real world, right? You have a debtor being also a creditor, or a creditor being also a debtor, right? So it does happen. And on the debit side here, for the closing balance, you realize that we have, you know, the closing balance on the debit side, which should not be, right? But it means again that at the end of the period we still owe some debtors money, because the norm would be for the opening balance to be on the debit side and the closing balance to be on the credit side, right? So anytime you see the opening balance on the credit side and the closing balance on the debit side, you know that it is not the norm, and it means that we owe our debtors money, or some of our debtors money. Alright, so that is what it means. So the next thing is, on the debit side, we find the items that increases our debtors. For example, credit sales. So if you are selling goods on credit, obviously it's going to increase the amount of money that is owed to us by debtors. This honored check is basically when the check, we call it in Jamaica, when the check bounce, right? When the bank is not able to fill or to cash the check, maybe because there is not enough money in the account, or maybe you know, this check is still dated, but the check is just dishonored. And then refunds, right? Normally when your customers pay you money, you would have credited you know, their account, right? That's just like this right here. But then if they pay too much, then you would have to send back some of that money to them, so you would have to debit it. So that's why refund is on this side. On the credit side, now we find items that decreases debtors. So when your debtors pay you money, here it is on the credit side, because it would have been on the credit side in their account, just like Tom and just like Mark that we just looked at, right? Now for discount allowed is when we give our customers a discount, and what it does is it reduces the amount that they pay to you, therefore it would go on the credit side of the sales ledger control. Returns inwards is another one that reduces the amount that the debtors owe you, right? And then bad debt is when your debtors are unable to repay for various reasons. Maybe, you know, their business go bankrupt, or God forbid, but they died, you know, then the debt would be bad. They can't pay it back. And then we have this term here, set off. Very important term. Now set off is when you know, like in this case now, we owe some of our debtors money, right? And you know, obviously they owe us money. Now when if we owe them money and them owe us money, then the amount that they owe us can be set off, quote unquote, or it can be squeezed out, as we call it in Jamaica, against the amount that we owe them. Alright, so instead of them paying us the full amount, then the amount that they owe to us, right, the amount that we owe to them can be set off against the amount that they owe to us, right? And so it would be here on the credit side. Set off is like a contra entry. It's going to be on the credit side of the sales ledger control, and it's going to be on the debit side in the purchases ledger control. So it comes in both control accounts, right? That is why I say it is a kind of contra type of entry, right? So it appears in the credit side of the sales ledger control and in the debit side of the purchases ledger control, right? And there you go, right? That is it for the sales ledger control account. Let's go now to the purchases ledger control. Now the purchases ledger control is like the opposite of the sales ledger control, because it relates to creditors, right? So on the debit side, it is used to record items that decreases your creditors, right? So the debit side is used to record items that decreases your creditors. And on the credit side, however, of the purchases ledger control, it is used to record items that increases your creditors. So over here, you will find items that increase your creditors, and on the debit side you will find items that decreases your creditors, right? It is important to also note that the purchases ledger control has less amount of items than the sales ledger control. In exams, the sales ledger control account normally carries more marks than the purchases ledger or the creditors control. Alright, so on the debit side you would find, well, I want you to realize as well that we have two opening balances. The norm for the creditors control is for the opening balance to be on the credit side. So you see it has more figures here, right? And the norm is for the balance carried down to be on the debit side. That is the norm. But in events where you see they have balance brought down on the debit side and the balance carried down on the credit side, right? It means that your creditors owe you money. So you owe your creditors money, but your creditors also owe you money, right? And that is what it means, right? That is why we have two balances, opening balances and two closing balances. All right, so let us look at the debit side, and remember that these are items that decreases your creditors, right? So you have bank or cash paid to suppliers, right? So if you pay your creditors money, then it reduces the amount of money what you owe to the creditors, right? If you receive discount from your creditors, then it reduces the amount of money that you owe to your creditors as well. And if you send back goods that are unsatisfactory to your suppliers, then that is returned outwards, and it reduces the amount of money that you owe to your creditors. Then here we have set off again, right? So your creditors owe you, and you also owe your creditors, right? So instead of your creditors paying you, right, the amount that is owed to your creditors is set off against what they owe you. All right, and so basically that's the creditors control, and that is basically control accounts for you in concepts and principles, right? Please remember to like, subscribe, and share. Hit that notification bell that you never miss a free tutorial, right? In my next video I will do a practice paper, a past paper question, right? So just stick around, right? And we'll talk. Wow, good.